Let's talk about the profession of investor relations. In fact, I perhaps can make a claim that investor relations is one of the most important professions for modern day American society. In fact, I perhaps can even make a claim that the whole survival of the US economy depends on the investor relations. Let me explain. So the modern market, capitalistic market, is based on something called efficient market hypothesis. The efficient market hypothesis states that a market in which prices always fully reflect available information is called efficient. In other words, the price of shares, the price of the stock traded today should fully reflect all available information about that stock. So if we know, for example, that some pharmaceutical company is going to come up with an outstanding vaccine against a disease that can cause a global pandemic, then this information is already reflected in the price of the stock, and somebody cannot secretly take advantage of that information by buying all the stock before this information is reflected in the price and then selling it later when the price goes up. So this is the idea. This is how the markets operate. However, this hypothesis is based on several assumptions. Assumption number one: all relevant information about the company and its performance is publicly available. So if somebody has the information that the company will develop a vaccine against a very, very dangerous disease, and that person is the only person who has that information and it's not publicly available, then the market is not going to be efficient, because the public is not going to treat the company as capable of huge growth in the future. Yet that person who would know about the vaccine will definitely be able to profit on this information. And whose job is it to make sure that all relevant information is public? This is the job for investor relations. This is one of the key functions of investor relations professionals, called disclosure of information. Anytime there is relevant information in investor relations, it's often called material information, meaning the one that can have material effect on the price of the stock. The investor relations officer's job is to disclose that information so that current shareholders and potential shareholders would know all that information, so that all information is publicly available. And there are specific laws and regulations, even going back to the 1933 and 1934 Securities Act and Securities and Exchange Act, that tell us about publicly available information and the importance of disclosing that information to the public. Now, the second assumption for the market to be efficient is all market participants have equal access to such information on a timely basis. What does it mean? It's not enough to have all the material information publicly available. It is extremely important to make sure that that information becomes publicly available at the same time for everybody. Because even if there is delay in a day or two or a week or even an hour in releasing information to, let's say, professional big investors and small private investors, those big professional investors, during that extra hour they have, or an extra day they have, or an extra week they have, they can reap the profits by buying the stock while it's still cheap, before others people were had an opportunity to know the information and react to the information, and then selling it when everybody else knows about it and reacts to that information and the prices grow. So whose job is it again to make sure that all participants have equal access to such information? It is also a job of the investor relations officers. A famous regulation FD, regulation fee disclosure, provides specific guidelines for the investor relations professionals on how they need to make sure that everybody has fair access to information, and there is a fair disclosure that goes to everybody at the same time, and there are specific rules guiding again investor relations professionals in the event that a company accidentally discloses it in a selective manner. If the selective disclosure happened, what to do and how to make sure that that selective disclosure quickly turns into a public disclosure. And even if it's not investor relations person, if it's CEO of the company or CFO of the company or anybody else from the company accidentally discloses something not in a public manner, and so creates a selective disclosure, then there are guidelines how to make it public disclosure. So again, all relevant information, equal access, and finally, all investors are rational and capable of evaluating the information available to them. This is the most interesting one, because what it's saying is it's not enough to give people the information. It's not enough to make sure that it goes to everybody at the same time. You're also kind of responsible for making sure they're capable of evaluating it the right way. And some may disagree with me, but I would say that this is also a job of the investor relations officer. In my time working in investor relations, I would never stop at just disclosing information. I also made sure that I'm available to the investors to explain to them, to answer their questions about the information. Because in many cases, it is difficult for an investor who is an outsider of the company to understand how that information that they received actually going to influence the company's business model, and as a result, the company's price. If there is a new vaccine being developed that can potentially stop the spread of a disease causing a pandemic, it usually takes a lot of steps before that vaccine can be actually created. Maybe it is developing a particular chemical compound. Maybe it's 10 different chemical compounds. Then selecting which one is the most effective and all the different tests that need to be done. And so investors who are financial professionals may not understand all the chemical formulas and everything else. And so then it's a job of the investor relations officer to explain that to them and educate them on all of this. And I'm not saying that investor relations officers should be experts in everything, but it definitely helps if you understand the industry in which the company operates. But you also you are insider. As an investor relations officer, you are inside the company. So you have access to all the company resources that financial analysts do not have. So you can go to your chemists. You can connect the chemist to the investor, so you can go to the chemist yourself, understand the relevant parts, and then communicate them to the investors. Sometimes it's not necessarily a scientific discovery. Sometimes it's maybe something obvious, but very unique for the company. For example, Walmart's transportation technology and the efficiency that they create with being able to ship across the country and across the world, honestly, all the goods, and making sure that they don't have a lot of stuff in the warehouses. So it's all very efficient, it's on demand, and makes them capable of being the lowest price provider. So explaining all that again to a financial analyst, how exactly Walmart does it, so that they have the best in their transportation network and their on-time delivery and everything else. Again, often it's not enough to just disclose that information. It's important to actually educate investors on that. And so all these three assumptions are required for the efficient market to operate and for the US economy to operate, and all three of them depend on the investor relations. And so that's why I'm making a claim that investor relations is one of the most important professions for the capitalistic society. And because of all of that, I often like to call investor relations as a function of managing expectations. You have the information, you disclose the information, you communicate it in a timely manner to everybody, you educate investors what's going on, and that creates expectations of investors. They want to say, well, we think that next year the company should do that or do this. And the problem with that in addition to all the good stuff, sometimes there are there is bad stuff. And it's not necessarily bad stuff, but it's challenges. For example, if you tell them about a chemical compound that your company discovered that it shows very promising, the expectations may be through the roof. It is important then for you as investor relations officer to manage those expectations. To explain that, yeah, the chemical compound shows promise in protecting against a certain disease, but testing is required. There may be false positives, there might be false negatives. A lot of research is needed, a lot of budget is needed. So it is important for investor relations professionals to be open and transparent. Because if investors have very high expectations, through the roof expectations, and your company cannot meet them next year, for example, then you may hurt the image of your company, the reputation of your company, and the share price of your company even more than if you're open from the very beginning and transparent on all the benefits and challenges the company is facing. And so when I think about investor relations, I always think about it as a function of managing expectations. And it's not just expectations of investors. Quite often it's expectation of your CEO and CFO and other top managers at your company, because they also have expectations. And sometimes it is your job to manage them as well. Now, with that being said, how many do you think investor relations officers are out there? How big do you think that profession is? You can pause the video and think about it for a minute, and then say your answer out loud. And now I'll tell you my answer, because NIRI, which is a National Investor Relations Institute, the largest professional organization of investor relations officers in the world. It is really a global organization, despite the fact that it has an national in its name. There are members from all over the world in NIRI. But it has only 3,300 members. And some of them are not even investor relations officers. Some of them are service providers. Business Wire, Market Wire, different agencies, and so on and so forth. So it is probably under 3,000 members who are actually investor relations officers. It's a very, very small occupation. Many people know each other very well. It's a very close-knit community. Some people like it, some people don't like it. In comparison, PRSA, which is Public Relations Society of America, has 22,000 members. IABC, International Association of Business Communicators, another corporate communicator organization, has 12,000 members. And Certified Financial Analyst Institute, which is the people whom investor relations officers often communicate with, has 150,000 members. So 3,000 investor relations officers are responsible for 150,000 financial analysts. This is not an easy task, as you can realize. But why is the number so small? Why do we have only 3,000 members? And what's interesting, if you think the number is going up or down, are we getting more investor relations officers with every year, or are we getting less investor relations officers with every year? Is it a growing profession, or is it a declining profession? Well, this is not an easy question to answer. The reason for that is it's a cyclical process. Right now, the number of investor relations officers is actually going down. I think only 10 years ago, there were almost 5,000 members in NIRI, in National Investor Relations Institute. And now, as I told you, it's closer to 3,000. The number declined quite significantly. And one of the reasons it declined, because the number of public companies, remember the companies that are available for the public to buy, the companies that have shares, the companies that have to have investor relations, their number also declined in the United States from about 10,000 to only 4,000. So now that makes sense. If there are only 4,000 publicly traded companies, we don't really need more than 4,000 investor relations officers. Because where else would they be working? Their only option would be public companies. The number of IPOs, which is initial public offering, this is the process when a company becomes public, when a company releases the shares for everybody to buy, also went down from 363 IPOs a year on average to 128 IPOs a year on average. So we have less public companies in general, but we also have less new public companies appearing every year. What is going on here? Is it the collapse of the US economy? I thought the economy is growing like crazy. What is the reason behind it? So I want you again to pause this video and think for a minute, what do you think is going on? Alright, so you had the chance to think about it. Now I'll give you a lot of reasons, a lot of explanation for these numbers I just presented. Number one, monopolization of the market. It is true that there are less and less IPOs every year, but the IPOs themselves are significantly larger. In 1996, average company that went through an IPO raised $85 million. That's it. The valuation of the company was $85 million. In 2014, the average size of an IPO became $186 million. Very significant increase. If we go back again to 1996, 54% of all IPOs were less than $75 million. So more than half of the companies were smaller companies. Today, it is very difficult to see an IPO that is below $75 million. Only 4% in 2014. So there are less IPOs because they are bigger by itself. Investors have bigger expectations. They're not going to buy a company if they don't understand how it's going to dominate the market. In 1996, it was enough to have a product to present to the market. Today, the expectation is you have to dominate the market. You cannot just be part of it. You have to win it and squish everybody else. This is very different perspective. And obviously, in order to dominate the market, you have to be a bigger company. So a lot of small companies cannot even go on the IPO. They cannot survive as a publicly traded company. So the changes in expectation and changes in the business model and changes in size affected the amount of companies and as a result amount of investor relations officers. Another trend that we have today is mergers and acquisitions. As I said, smaller companies today don't really have a lot of opportunities to go for an IPO. What do they do instead? They get acquired. WhatsApp, for example, could have been a wonderful IPO company, but they were not big enough, and Facebook simply bought them. Didn't have a chance to go through an IPO, through becoming a public company. Instead, Facebook acquired them. Smaller companies may merge together to form one bigger companies, so that again they can dominate the market and they can go for IPO, or they can be acquired by even bigger company. Obviously, if you have all these mergers and acquisitions, it means instead of 3, 4, 5 different companies, we now have one giant company. And so instead of 5 investor relations officers, we may have one investor relations officer responsible for all those 5 businesses together. Think at the Alphabet, for example, the conglomerate that has a lot of businesses underneath it. Each one of these businesses can be a separate company, but no, today they're all together. Or again, Facebook, it's kind of strange to call it a social app, to call it a conglomerate, but if you take Facebook and Instagram and WhatsApp and you put all of them together, it is a conglomerate. How else can you call it? Another trend is we simply have less investors. When I talked about the history of investor relations, I said that at the beginning, most of the investors were regular people. They would buy 1, 2, 3 shares of a company, and the company would communicate with their shareholders directly. Today, it is very rare for people to own on their own stock of the company directly. A lot of the investment is done through mutual funds and pension funds, and those funds accumulate millions and billions of dollars. And they cannot make an investment in a company that is below $75 million because their typical investment may be $10 million. And if they invest all that into a small company, that can significantly change its valuation. And then they cannot sell it because it will destroy the valuation of the company. So they are looking for big companies. Many of them have regulations about how small they can go. They may not be even allowed to invest in a small company. So we have less investors, and these investors are bigger as well because they accumulate money from other investors, and so they have to have bigger companies in order to invest in. There is also more money available elsewhere. Maybe you don't even want to be a publicly traded company today and borrow money from the people on the market. If there is a very low interest available, you can just go to the bank and borrow money without giving any of the ownership to your company. Fear of shareholder activism. Again, I wouldn't call it one of the main reasons, but it's definitely a reason. And if you read recent publications related to that, you hear Elon Musk, for example, talking about his unhappiness with the fact that he has to listen to shareholders and kind of explain to them his strategy. And I think in one interview I even read that he was very happy that SpaceX is not a shareholder company, because then it would be very difficult for him. Every time something goes bad, he would have to go and explain to the shareholders and respond to the criticism from shareholders and so on and so forth. Tesla is a shareholder company, so he has to kind of do that for Tesla. Different regulations. Many people in the investor relations industry are explaining that every year increases the cost of being a publicly traded company. More and more regulations are added almost every year, and it becomes a job of a corporation, job of the investor relations officers to make sure you meet all these regulations, all the requirements, all the guidelines, and it simply costs money. There is a discussion that there is a certain lack of trust between the public and the managers of the company. And if you are investing in a company, you're essentially giving your money to the management of the company, saying, I trust you to grow my money. I trust you to do well with this money and increase the company performance. And if there is no lack of trust, if you don't trust the managers of the corporation, you are less likely to invest in a particular company. And so the question of all of that, do we even need to care? Do we care that there are now less companies and less IROs and less IPOs, and the companies are bigger and there are less investors and so on and so forth? So again, I want you to pause the video and think about, does it affect you in any way or not? Well, there might be different opinions on that, but I think we do need to care about that. Because the same as with everything else, if we have less companies, less opportunities to invest, and they are bigger, again, we have less competition. And competition is healthy for the free market. And if we have less investors and less companies, there is less competition on both sides, and we're not necessarily achieving our best potential. Maybe there is less innovation, and I know the Google, for example, or Facebook or Apple are famous for being big corporations yet supporting innovation within them through different managerial structures. But this seems an artificial approach to creativity and innovation when these companies were young, small companies themselves. I would argue that they were significantly more innovative than they are today. And the same is with investors. There are less opportunities to how to invest your money. You have to go to those mutual fund, to pension funds. So there is like less investment strategies you can follow, and it's more difficult for you to make an independent decision, because in some of these companies, even one share can be in thousands or tens of thousands of dollars, which limits participation of investors and participation in the company. And again, decreased competition, decreased opportunities. I would argue that we do need to care, and it's not necessarily a good situation. And finally, I want to talk a little bit about salaries in the investor relations. And every year or every 2 years, there is research on the salaries in the investor relations. And in all that research, it is very common to see that investor relations is labeled the highest paid specialization of public relations and corporate communications. So the most recent one that came out in 2020 says that the average salary in investor relations is $250,000, which is not bad and significantly more than the average salary in public relations. So if salary is important to you, then definitely investor relations is a pretty good choice. And in their research, they also looked at 3 different levels of being investor relations officer. So the senior level IRO, like VP of investor relations, mid-level investor relations officer, and the beginning investor relations jobs. And as you can see on the screen, the beginning investor relations job, the lowest position in investor relations, pays about $140,000. The mid-level investor relations officer pays about $200,000, $201,000. And then the highest level, when you get into the VP level, it pays about $293,000. And the average salary, again, as I said, $250,000 in investor relations. So you can read more online if you go to Neary Korn Ferry salary survey. But this is it for now. And we'll continue next week.